Hey there, it's Rick Mount with Fairway Independent Mortgage. Happy Friday, September 20th. Want to bring you this week's Friday market update. A lot of stuff going on out there in the market, none of which is easily missed. As the Federal Open Market Committee meetings minutes were released this week, the big news was, as many expected, the federal government to begin the slowing or tapering of their purchasing of mortgage-backed securities and treasury notes, which they've been doing for some time now to help keep rates artificially low and help stimulate the economy and the home purchase market. The surprising news was is they decided not to taper. So this surprised the market, as many expected them to begin the taper as much as $10 to $15 billion less per month in acquiring these assets. So that surprised the market. As a result, the mortgage-backed securities market, bond market rallied, and rates have lowered. To give you perspective, we were starting to approach the high 4s, low 5% range, and now rates are back down into the low to mid 4% range for conventional financing, depending on where your FICO scores are. So good news from an interest rate environment. We'll keep an eye on how that's going to affect us long term. The big question now is, if they didn't taper now, when will they taper? And your guess is as good as mine. Many people smarter than I believe that it could be 2014 before we begin to see any signs of tapering. So, like I said, our good friend Mike White made the statement the other day that many people were expecting the Fed to wind down this low interest rate party and start taking the desserts and cookies off the table, but instead they left the cookies, brought out more cake, and refilled the punch bowl. So, like we talked about a little bit earlier in the conversation, we're not sure when they're going to begin to taper. Your guess is as good as mine, but with the debt ceiling, Obamacare, and this little thing called Syria and chemical weapons on the table, it could be 2014 before we send any signs of them reducing their spending to keep the low interest rate market there. So, speaking of the debt ceiling, it sounds like Uncle Sam's going to ask for his credit limit to be increased again. Currently, the debt limit is set at $16.7 trillion, and both political parties are again divided across the aisle on how they see this and how we best should deal with this. So look for that news to help create more volatility and turbulence that we have to pay attention to in the market. But not sure if we can spend our way to prosperity, so we'll certainly keep an eye on the debt limit and the impact that it has on the mortgage market. So looking back at history, just brief history, oftentimes in the real estate world, we'll look back. The National Association of Realtors announced that existing home sales increased in August and reached the highest level in 6.5 years, while the median price shows consecutive months of double-digit year-over-year growth. So don't get too excited. We all realize the market has been hot. There had been a lack of inventory. Obviously, artificially low interest rates have helped fuel the fire, but the trends are changing. So remember, this was reporting August closed data. Many of those contracts were negotiated May, June, and July, so there was a lagging effect. Lawrence Yun, the NAR's chief economist, also said the market may be experiencing a temporary peak. Rising mortgage interest rates push more buyers to close deals earlier, but monthly sales are likely to be uneven in the months ahead from several factors. Obviously, the raising rates, tightened inventories, limiting choices in some areas, and again, lending credit becomes an issue, as it's still not as open as many would like it to be. But with that being said, affordability still remains great. Obviously, now with slightly lower interest rates, more people can continue to refinance, put more money in their pocket. Hopefully that will help the economy as well, and it still makes housing very affordable, especially here in the Southern California market. Still a very healthy time to consider your options, both your existing real estate and for new real estate ventures. So remember, we take a financial planning approach to real estate lending. We help you take a deeper dive and make sure that the decisions you make are healthy. So volatile times, volatile market, we're here to help, and we look forward to working with you in any way we can. Make it a great, happy, and safe weekend. We'll talk to you soon.